Are you looking to maximize returns on your investments in 2026, but unsure where to focus your efforts? With the landscape of global finance rapidly changing, from AI infrastructure to alternative credit, understanding where to allocate capital has become more complex and critical. However, with the right strategies, you can tap into new opportunities that offer significant growth potential while managing risks. In this video, we'll explore the top 5 ways to maximize returns on your investments this year. From diversifying into real assets to utilizing private markets, these strategies will help you optimize your portfolio and make the most of today's market conditions. Let's dive in. 1. Pivot to AI infrastructure over pure software. In 2026, the focus has shifted from just investing in AI software companies to targeting the physical infrastructure that powers these technologies. As AI technology continues to grow, there's a rise in demand for the hardware and energy necessary to run complex AI models. This shift presents a tremendous investment opportunity, especially in sectors like chip manufacturing, data centers, and power grid operators. These industries form the backbone of the AI ecosystem, providing the critical infrastructure that enables AI models to function at scale. The strategy is to invest in companies that provide the infrastructure that supports AI, including semiconductor manufacturers, data center REITs, real estate investment trusts, and power grid operators located in regions with surplus clean energy. As AI-related capital expenditures are projected to approach $600 billion in 2026, the demand for these physical assets will only continue to rise. These sectors are poised for exponential growth as the world transitions into an AI-driven future, presenting investors with a unique opportunity to participate in the technological revolution. What makes this strategy particularly effective is that it allows you to capitalize on the foundational technologies behind AI, rather than simply relying on the software applications built on top of them. By focusing on AI infrastructure, you can invest in businesses that are crucial to the development and deployment of AI systems, offering steady returns driven by the increasing demand for more powerful and efficient systems to run AI models. This approach also provides a buffer against the volatility often seen in the software sector. As AI infrastructure is less susceptible to the ups and downs of market sentiment or the intense competition seen in the software space, it offers a more stable investment. For investors looking for long-term stability and growth, this strategy is ideal. The demand for AI infrastructure is projected to continue growing, making a safe yet rewarding investment in an increasingly tech-driven world. By targeting these foundational sectors, you position yourself to benefit from the immense expansion of the AI industry, while ensuring your portfolio remains resilient in the face of market fluctuations. 2. Utilize a barbell equity approach. In a year marked by market volatility, one of the most effective strategies for maximizing returns while managing risk is the barbell equity approach. This strategy involves balancing your portfolio with both high-risk, high-reward assets and low-risk, defensive investments, creating a portfolio that can weather market fluctuations while still capturing significant upside potential. The strategy works by allocating a portion of your portfolio to aggressive sectors, such as tech and biotech, where growth is expected to be substantial. These sectors have the potential to generate high returns, but they also come with increased risk, particularly in today's rapidly changing market. At the same time, you anchor the portfolio with defensive sectors like utilities, healthcare, and infrastructure, which tend to be more stable and provide steady income during periods of market uncertainty. The benefit of the barbell equity approach is that it allows you to participate in the upside trends, such as the booming AI and biotech industries, while protecting your capital with more conservative investments. This is especially important in the current economic environment, where boom-bust cycles are common and market volatility can cause sharp swings in asset prices. By balancing high-growth investments with stable ones, you position yourself to benefit from market growth without putting your entire portfolio at risk. This approach is ideal for investors who want to capture high returns while managing risk in an uncertain market. 3. Capture yield in intermediate-term bonds. With fluctuating interest rates and ongoing market uncertainty, the traditional approach of investing in long-term bonds or short-term savings accounts may not be the most optimal strategy for 2026. Instead, investors can maximize returns by focusing on intermediate-term bonds, which offer the best balance of risk and reward in today's market. The strategy is to focus on bonds with 5-year maturities rather than very short or long-term debt. Intermediate-term bonds provide a stable source of income without exposing you to the high volatility of long-term bonds during inflationary spikes. These bonds are less sensitive to interest rate changes compared to short-term bonds, making them an ideal choice for the current interest rate environment. The benefit of this strategy is that it allows you to capture higher yields in short-term bonds while avoiding the risk of long-term bonds that are highly sensitive to interest rate cuts. With interest rates fluctuating, these intermediate-term bonds are insulated from the volatility seen in the bond market, providing steady returns and income. By allocating a portion of your portfolio to these bonds, you can enhance the yield on your fixed income investments without taking on unnecessary risk. This strategy is perfect for investors who want to maintain a steady cash flow while minimizing exposure to interest rate fluctuations, allowing for more predictable and for direct capital to alternative, credit, and private markets. The rise of private markets has created exciting opportunities for individual investors, allowing them to access assets that were previously reserved for institutional investors. Through structural innovations like evergreen funds, private credit, senior loans, and infrastructure debt are now available to individual investors looking to enhance their income and diversify their portfolios. The strategy here is to allocate capital to alternative credit markets, such as private credit funds and infrastructure debt. These investments often offer higher yields compared to traditional fixed income assets like government or corporate bonds, and have a low correlation to public stock markets, providing a valuable hedge against equity market sell-offs. The benefit of this strategy is twofold. It offers higher yields than traditional fixed income while providing greater diversification, as these assets don't typically move in tandem with the stock market. This makes them an excellent way to balance risk and reward in your portfolio. Alternative credit investments can also offer more stable returns, especially in times of economic uncertainty, when stock markets may be volatile. Private markets provide access to lucrative, high-yield assets that can help boost your income, especially if you have a longer investment horizon. By incorporating alternative credit into your portfolio, you can significantly enhance your income and provide a hedge against the risks associated with traditional equity markets. 5. Hedge with real assets, gold and silver. In 2026, global debt levels and geopolitical uncertainty are top concerns for investors. To protect your wealth and hedge against these risks, incorporating physical assets like gold and silver into your portfolio is becoming more critical than ever. The strategy is to allocate 5 to 10% of your portfolio to gold or silver, either through physical ownership or through exchange-traded funds, ETFs, that track the price of precious metals. Gold and silver are widely considered safe haven assets that retain value during periods of currency debasement, inflation, or geopolitical instability. As central banks and governments around the world print more money, the value of fiat currencies can erode, making real assets like gold and silver a strategic hedge. The benefit of this strategy is that it provides protection against currency risk, inflation, and other economic shocks. As institutional investors increasingly turn to precious metals to safeguard their portfolios, individuals can also benefit from diversifying into real assets. Gold and silver serve as a store of value during uncertain times, providing a stable asset that can hold its worth even when the stock market faces challenges. By allocating a portion of your portfolio to real assets, you ensure that your wealth is protected from the risks of inflation and currency devaluation, while still having exposure to a potential upside if gold and silver prices rise. There you have it, the top 5 ways to maximize returns on your investments in 2026. From pivoting to AI infrastructure to incorporating real assets like gold and silver into your portfolio, these strategies offer diverse ways to boost your financial growth while managing risk. Whether you're looking for high returns or seeking stability, these strategies provide a roadmap for navigating today's market challenges. If you found this video helpful, don't forget to like, share, and subscribe for more investment insights. Let me know in the comments which strategy you're most excited to try. I'll see you in the next video.